Wait till we get started.
Wait till we get started.
Please,
Yeah.
yeah.
Okay.
Yeah. I mean, so,
Absolutely.
that's a good, that's a good one.
I'll be next to the plan.
My client is Florida. From the notes I was here. Yeah. I like it. I figured I might need to. Yeah, I bought the farm, it shouldn't come in tomorrow. Yeah. For $9. Oh, I scoured the super. I needed to pay one. I will the bin. Oh, yeah, they're buying that online, yeah, but it's like 240s, is it? I'm like, it's only around like 6 months. Yeah. It's like, I used to, yeah, I was like, this is $200, yeah, it's $200. So how I thought it only cost me $10 to do it, but it's not. Yeah. It was
What is it?
17. 17.
Okay, it's time. Let's get started. Any questions? Thank you. All right. Well, thank you a lot to take down. So I can get everything set up and then take questions at the top of the hour. Usually somebody else does the same question. So if you're doing me a favor, you just wait until we get started. Just let everybody remember and hear what we got going on. Okay. Our question for the ebook. Are we supposed to actually buy it or is there I just kind of like a free trial right now? You're supposed to actually buy it. Actually pay for it. Yeah, actually, you'll have to pay for. You have to pay for the book to get access to the course. Yeah. And then there's a code. I know. Thank you for asking that question.
You also buy just the course and get the book separately if you need to.
So you can also buy just the course and get the books separately if you need to. If you buy the course, once you're into the course shelf, the books there, like you can see it all. I don't like to. I get headaches when I tried to read it online, so I like to have the hard copy of things available too. But once you have access to this shell, let's see here. Let me just go to the course home. You can go to, let me go to module 3. That's what I'm lecturing on tonight. So here's module 3, and you can click through onto the readings there, the little blue tab, and it's going to take you to a launch of the e-reader. So this is the whole textbook available to everybody that's inside of that shell. And the electronic version of the book has some nice features that'll summarize all the learning objectives and give you little videos, and it'll allow you to highlight the text, and there's some other features in there that I've never used them, so I don't know how useful they are, but some of you may find them terrific. Any other questions about access to the text or access to the syllabus?
Thompson 1, is there an alternative that you want us to use for that, or where there was a reference looking at Thompson 1? I think of her database.
Thank you for asking that question. It's a great question. And unfortunately, the university, Block School, they let their subscription to Thompson 1 lapse. I get it. It's a $40,000 fee. It's an incredible piece of software. It's unfortunate that we don't get to use it because there's all kinds of fun toys out there. What we do get to use is FactSet. So I have FactSet pulled up on the screen here. You can just go to factset.com. It'll bring up the login. And we're going to be using this quite a bit this semester. I submitted everybody that had already registered through the My Business Course website. I have your name and email address. I submitted it to Dr. Clark. Dr. Clark is the one that has to request your access. So look for an email, and if you don't get an email, just send me first name, last name, email address, and I'll send it over to Dr. Clark, and you'll be able to get access to the system. This system has almost everything that we're gonna need for the entire course. It's very robust. What we don't have access to through FactSet that is very helpful is Wall Street research. So I pulled up our little, this as of last semester represented the list of companies that everybody had to choose from. So your company's probably on this list. So I pulled it up in FactSet and I sorted it by the percentage change. So does anybody have Goodyear Tire and Rubber? Did anybody select Goodyear? Okay, well, Goodyear was up 6.75% today. What's the next question you're asking yourself? Well, why? Why is always the next question. What happened? They probably reported earnings and beat expectations. How do you find expectations? Well, expectations are simply an average of what the Wall Street analysts think those earnings are going to be. And the Wall Street analysts include brokerage houses like Goldman Sachs and Bank of America and Merrill Lynch and Morgan Stanley. They all publish research. We don't have the version of FactSet that shares those research reports, but we do have the version of Bloomberg that shares those research reports, and you can find them all across the hall. If you go over to Bloomberg, log in, you'll be able to find those research reports. They're terrific. That's what we're doing this semester with our case project. It's a third of your grade, and little inside tip for you all. All of them. Goldman Sachs has already done this for you. Go across to the Bloomberg terminal, find their research, and save that report. And then you're going to use that as a source stuff. And this really becomes a download and share and compare project. It's imperative that you recognize all of the research that's already been done so you can draw on that and assimilate your own report and your own opinion and defend that a little bit. So we're going to use Bloomberg as a source, we're going to use FactSet as a source, we're going to use some of the other libraries that are free to students and faculty through the block library, Linda Hall Library, and I'll show you how to access some of those research databases, but it really comes together in a way that's not too overwhelming. But I'm getting a little bit ahead of myself. We'll talk a lot more about what goes into that research project. Tonight I'm going to lecture on module 3. Any questions about, we already talked about access to the course shell, homework, get set up with the class, access on our YouTube side. How's everybody doing? So far, so good. Okay. Well, if something hits you, just interrupt me at any time. Tonight we're going to be talking about return on equity. Your first project was to download the proxy. I wanted you to read it, skim it, throw it into ChatGPT and have ChatGPT summarize it. I really just wanted you to familiarize yourself with the proxy, with the primary assignment there being find out how your management teams get paid. And I want to know what their incentive compensation is linked to. Has anybody made it far enough to identify incentive compensation linked to tonight's topic, which is return on equity? Okay, so nobody's there yet, but this is one of the more common incentive compensation. So if you're the CEO of Goodyear Tire and Rubber or Pepsi or Exxon, the chances are you're going to have an incentive compensation package that's linked to or partially linked to return on equity. So we're going to talk a little bit tonight about how that's calculated. And then we're going to play a little game, this quote unquote game that I call follow the penny, which is me asking you to put yourselves in the job of CEO. You've hired yourself as CEO or you've hired yourself as CFO. And I want you to ask yourself, well, if I wanted to trigger my incentive-based stock options, if I wanted those to price so that I could exercise my options or I could get myself paid, what accounting treatment would I elect? How would I run this company if I wanted to get myself paid because I knew my salary was linked to return on equity? That's what we're talking about. So very high level, what is return on equity? It's a simple calculation. We have return or profits in the numerator, divided by equity. And equity is simply one of the components that goes into financing a business. When you start a car wash or a tailor or drive-through, you pony up a little bit of your own money, so you write a check, and then you go to the bank and you borrow a little bit. So those two components are debt from the bank and equity from your own account. What we're concerned about as shareholders, because we own the company, we're always pretending that we own these businesses because we're analyzing these businesses from the perspective of the common shareholder. So we own this business. We're the head honcho. We care about return on equity because equity is our money. So we're calculating what our percentage rate of return is. If we put in $100,000 and we make $10,000, what's our return on equity? 10%. Okay. How do we feel about that? Is 10% good? Is 10% bad? How would you begin to answer the question, okay, we just operated for a whole year, whatever our business was. We calculated our return on equity. We got profit in the numerator, equity in the denominator. We know we had a 10% rate of return. Is that good or bad? Anybody that's ever worked for a business or ran a business or invested in a bank account or put money to work in the stock market?
If I was owning that business, I would be happy to survive the year and got 10%.
Okay, 10%.
Year one, yay.
That sounds great.
Yeah.
That sounds great. What? Another opinion back here.
See, maybe we can compare it to some of our peer firms and see how their return on equity stacks up with ours.
Okay, everything in life is relative, right? You know, I love my car until my neighbor gets about a bigger one. So I love 10% until I find out that my competition down the street's doing 20, and then I'm like, oh, yikes. Now all of a sudden I gotta go to the board. I'm CEO, you're CEO. You gotta go to the board of directors and say, we made 10% for you last year, and what's the board gonna say? Well, your competition made 20, or your competition made 5. So that's great perspective, and everything we look at all semester long, you get tired of hearing this. Every ratio that we look at all semester long, I'm gonna tell you to look at it relative to the peer group. We can find the peer group using Pepsi. Sometimes it's a little challenging to find a good peer group because, like tonight, we're gonna be looking at Pfizer, and Pfizer is a decent peer group, but Eli Lilly's not identical with Pfizer, and Merck is not identical with Pfizer, but they're similar. So you can gain some insights. So I'm going to be telling you all semester long to look at every ratio relative to your peer group and relative to fill in the blank. Any guesses?
Last year.
Last year, historicals. So you got 2 charts I want you to build for every ratio we look at. Versus peers and versus your own historicals. So again, 10% sounds pretty good. Unless we did 20 last year. 10% is terrific if we did 5 last year. Okay, now let's broaden the aperture a little bit and take you back to your investing 101 class or your finance 101 class. When you think of stock markets in general, CAPM, capital asset pricing model, everything is relative. What do we generally compare investments to? Risk-free rate. So we always start with the risk-free rate. What's the 10-year treasury? What's the yield on the 10-year treasury today? 4.3%. 4.3%. That's pretty good. That's pretty close. I was gonna say 4.2, but you're probably ahead of me. So 4.3%. If we return 10, that's what, a little over 2 times the 10-year treasury. You got a spread of about 6% to the 10-year treasury. That puts you pretty squarely in line. That difference right there. If you take the return on equity minus the 10-year treasury, you're calculating something called the risk spread or the risk premium. That risk premium of about 6%, that's the historical average for the S&P 500. If you go back 50, 60, 100 years, and you look at the return to the S&P 500 or the return to U.S. stocks, you'll see it's somewhere between 9 and 11%, depending on the time period. And the return to the U.S. Treasury bonds on average has been between 4 and 6. That makes the risk premium right there around 6%. So we've identified a 10% return in a market where the Treasury is yielding about 4%. So we're right in the sweet spot of what you would think of as an average company for the S&P 500. And then the next challenge is to veer off into, well, what industry are we in? Because we're not average. If we're good, you're tire and rubber, that's probably great. If we're NVIDIA, that's probably pretty terrible. They're having a really bad quarter if you're NVIDIA and you're trading it. I don't even know if NVIDIA's trading at now 50 times earnings, and then you return an ROE of 10%. Your shareholders are not very happy with that. Okay, so that's a big setup for ROE. As we move through the slides, I'm going to be asking you to think to yourselves, how would I don't like to use the word manipulate, but we can use the word manipulate. I see shenanigans all over finance when executives are trying to elect their accounting treatment. So yeah, there are plenty of opportunities to manipulate the accounting. Okay. All right, I'm going to skip around these slides a little bit because I like the yap and I just previewed probably 10 slides that we were supposed to look at tonight. But you get the basic equation. Net income, that's profit. How much money did we make? These, it's simple. It's not as challenging as the nomenclature would make it out to be. We're simply calculating how much money we made and we're dividing by average stockholders' equity, which is how much money we put into the business. You're going to see our authors, the authors of the text. They're very precise and they're very technically accurate. The numerator of this equation says average stockholders' equity. Where do we find equity? What financial statement do we find equity on? But we find equity on the balance sheet. And the balance sheet is published how often? Once a quarter, once a year. And at the end of the year, well, the top of that balance sheet is going to read balance sheet for year ending 12/31/2025 or whatever your fiscal year is. And it's printed as of a single date. Okay, that's important because we only know equity as of a single point in time. What's in the numerator? Net income. Well, is that net income as of a single point in time? No, that's got to be net income over a period of time. How much money did we make over what period? For the sake of our conversation, let's just say that we're talking about an annualized period. So you have a year's worth of equity. You can't divide that by, you have a year's worth of net income, excuse me. You can't divide that by equity at a single point in time. You need to divide that by an average of the equity that was outstanding during the period you earned the income. Now you've matched the time frames of the numerator and the denominator. That's what I call technically accurate. When you start your own mutual fund company or start your own RIA firm, or you're out there creating spreadsheets for American Century or Buffalo Funds or Morgan Stanley or whoever, you're going to recognize that sometimes it's just easier to put stockholders' equity in the denominator. And you're going to see me take shortcuts all semester long because I've been taking shortcuts my entire career because this is a finance class. This is not an accounting class. If this were an accounting class, then I would expect you to have the correct answers to the second decimal point. We're not publishing financials. That's not the purpose of this class. We're using the financials that have already been published. The reason for this class is something else. We approach it as if we're stock analysts trying to figure out what these stocks are worth so we can buy them or sell them. And if that's the use case, then the best we can ever hope for, because we're trying to predict the future and we don't have a crystal ball, the best we can ever hope for is to be directionally correct. Is this stock going to go up or is this stock going to go down? So we can take a shortcut. If stockholders' equity this year was about the same as it was last year, then punt the average and just stick in this year's stockholders' equity. I need for you all to understand this conceptually, and then I authorize you, I give you the latitude to take the same shortcuts I do when we're trying to get to an answer that ultimately benefits the shareholders that we represent when we're doing these projects. Clear as mud, I know, but there'll be a lot more of that. let's calculate Pfizer's return on equity. So these financials are given by our authors. We have revenues, net income before allocation of non-controlling interest. We'll talk about that. And then we have net income attributable to Pfizer's common shareholders. That's net income. $31 billion in December of 2022, $21 billion in December of 2021, almost a 50% increase. Any guesses as to why? Yeah, I think it's very interesting that our authors give us Pfizer during a period of time where their earnings were absolutely exploding because the government said we all had to take their product. I'm not getting political on anybody. I just like looking at the financials during that period of time because we just saw their earnings explode, and we're going to see their financials represent that as we plow through their balance sheet. So their equity went from 77 billion to 95 billion. We have 31 billion in the numerator, calculate the average there, for a 36.3% return on equity. Here's a nice data point. ROE for S&P 500 firms ranged from 13 to 17 between 2018 and 2022. So Pfizer's crushing. By any measure, a 36% return on equity is going to make all the shareholders happy. And of course, if you owned Pfizer during that period of time, you did very, very well. Okay, now on the non-controlling interest. You saw that on the last slide. This is a little nuisance. Conceptually, I think for everybody in the class to understand what non-controlling interest is, you're going to be given homework projects. You're going to be have some multiple choice of how to show it on the test. But for practical purposes, it's usually negative. And this goes right back to what I was talking about with the average equity in the denominator. If it's negligible, then we can discard it. So that's a big principle, that's a big concept in our world of finance and investing, is materiality. If anything that we're talking about is deemed to be non-material, we can forget about it. We can just, and you need to forget about it. You need to, part of this business, you want to take your diploma and go into the world of financial analysis. Part of that skill set that you will apply is to quickly recognize something that's material from non-material. The best analysts can kind of survey the landscape, look at a company, analyze a deal, and know what matters from what doesn't matter. So non-controlling interest for most of us in here, for most of the companies that we're going to be looking at, doesn't matter. But there might be one or two where non-controlling interest is needed. And if it is, you're going to have to make some adjustments to all of the ratios that we're talking about tonight and in the near future. What is non-controlling? Okay, imagine a company like Berkshire Hathaway. Berkshire Hathaway is one of my all-time favorites. Warren Buffett is an investing guru. I've always looked up to his style. I like to read his shareholder letters. I've been to the annual meetings. Recently lost his partnership, Charlie Munger, for years and years and years. The Berkshire Hathaway annual shareholder meeting was referred to as Woodstock of capitalists. And it would draw 50,000 investors to Omaha, Nebraska, to sit in this huge stadium and listen to these two 80, 90-year-olds just talk about their business for 4 hours. And they had a little shit going, and they tell a bunch of jokes, and they'd entertain everybody. But it was really a pretty good time, and there was a lot of wisdom that was shared. So Berkshire has been in business since the 50s, and they've acquired hundreds of companies during that period of time. And part of the fun of the shareholders meeting is that in the basement, Warren Buffett would market all the companies that he owns, and he'd sell the goods back to shareholders. So you could go and you could buy Justin Goods and Geico Insurance and NetJets and Coca-Cola, the Omaha Daily News, and the list just goes on and on and on. And it was really a pretty fun event. So imagine if Warren Buffett and Berkshire Hathaway buy Justin Boots. They own Justin Boots, and they go to the owner of Justin Boots and they say, we want to merge with your company, we want to buy your company. And they take a 90% stake in that business because the owner wants to retain some partial equity. They're not ready to fully sell out, but they're ready to mostly sell out. That is so common. That's so common. So now Berkshire owns 90% of that business. And the other little piece, that 10%, owned by somebody else. Well, that forces the issue and leads us into something called consolidated financial statements. So GAAP is going to require that we take 100% of the balance sheet of Berkshire Hathaway, 100% of the balance sheet of Red Wing Foods, or whatever the acquired company was, and present them as if they were one. But they're not one. They're 1.9, because Berkshire owns 90%, not 100%. So now you have assets on the books that represent larger than what they really should be. And that flows all the way down the balance sheet. We have 100% consolidation until you get down to that line item that was just on the last screen that says non-controlling interest. And that's the line item that reconciles for that consolidated account. Net income before non-controlling interest. So you have a little non-controlling interest that has rights to a certain piece of that net income. And like I said, it's usually negligible. But if it's not, then we have to make a little adjustment, and our authors show us how to make that adjustment on this slide number 6. We simply take the net income attributable to company shareholders and divide that by average equity attributable to company shareholders. Both of those terms already have the non-controlling interest factored out. We'll talk more about non-controlling interest. It'll come back into play. We also have to be mindful of preferred stock. This is more impactful than non-controlling interest from what I see. I don't expect NCI, non-controlling interest, to be meaningful for most of the people in this room, but preferred stock will. A lot of the companies that we're looking at have issues of preferred stock. Anybody seen that already? Anybody ever owned preferred stock? Okay. So preferred stock is another financing vehicle, and oftentimes you own a business, you'll need some money. So you can say you've already gone to the bank. The bank has already loaned you money at 8%. My business would loan from the bank, and we pay about 8% interest. If we wanted to, if we needed to access more capital, we could issue preferred stock. Preferred stock is a contractual agreement. So we have a contract between the issuer, the company, and the preferred stockholder. That would be you all in this example. And that contract can have any terms that we put in the document, which makes it both very challenging to decipher and also rich fishing grounds for finding opportunities. Because most investors, they don't want to read that contract that says what the rights of that preferred stock are, what the yields do on that preferred stock are, what the conversion privileges might be, and any covenants associated with that preferred stock that convey rights onto the holder. So we're going to look at it very simply and just say most preferred stock entitles the holder to a higher dividend yield. It might be, if you're paying 8% to the bank, then you're probably going to have to pay 9 or 10% to the holders of preferred stock because they take a lower place in the capital structure. But because it's contractual in nature and you have a legal liability to pay that coupon, we really need to factor it out from the calculation of return on equity. So when we do that, we get this one. Net income attributable to company shareholders minus preferred dividends divided by average equity attributable to company shareholders minus average preferred equity. Couple small adjustments there, but they're conceptual in nature, so I wanted to take a little time and make sure everybody understood. I won't dwell on the examples of the financial statements. You can see that our authors have given clear financial statements for Occidental Petroleum and highlighted the preferred stock and how it shows up on the balance sheet and so on and so forth. Let's move into return on equity. I want to break this down and talk a little bit about how financial analysts use return on equity, because the components and subcomponents of return on equity will tell us a story. and I wanna train, I wanna get us all kind of trained and on the same page. To take return on equity, break it down into its constituent components, and use those components to tell a story. Really, we're just looking at the trends of the underlying components. Every time, we're gonna take those, compare them to their peers, compare those components to their historical averages, and ask the question why. Why is this trending higher than it has historically? Why is this trending lower than it has historically? Why is this higher or lower than the peer group? To do that, we're going to look at something called a DuPont analysis. I'm hopeful this is familiar for some of you in the room. I would have expected that this had been touched on in some of your earlier finance classes. DuPont analysis, named for Professor DuPont, I forget where he studied, but this was his brainchild. And it takes return on equity and breaks it down into its constituent components. Those two higher order components are return on assets, ROA. So you have the same net income in the numerator, we're just dividing by total assets. So you can see the difference between return on equity and return on assets. It's just the numerator. In one we have equity, and in one we have assets. Now, let's just rewind basic accounting equation. Assets equals, somebody help me out. What do assets equal? Liabilities plus equity, let's just call liabilities debt for the sake of argument. So now the only difference between return on assets and return on equity becomes debt, which we call financial leverage in this equation. So really the only difference between return on equity and return on assets and return on equity is debt. And as you will see, the more debt we take on, the wider the dispersion between return on assets and return on equity. So very simply put, if we have a return on equity of 10% and we want that to go to 11% or 12% or 13%, one of the ways that we can get there is by borrowing more money. Okay, this is your first aha moment. Okay. If in the future you're in the C-suite and your incentive-based comp is linked to return on equity, and you need to get that return on equity to 11%, but you're only at 10%. What do? It's just the math. It's just the math. If you do the exact same thing you did last year, but you do it with borrowed money, you have a higher return on equity. Did you really do anything different? No, you just go to the bank, borrow a little bit more money, you ran the same playbook. Now you have a higher return on equity, and you're cashing in often that you exercise. You can see the little stub here, the non-controlling interest ratio. That's gonna follow us around, so be mindful of that. Let's break down return on equity into company performance. That's return on assets. Financial leverage, that second component, is how the firm is financed. And we separate those because, you know, sometimes it's not as easy as just borrowing more money. Sometimes it is. Sometimes the board will actually say, if you want to borrow more money, you have to get board approval. And the CEO and CFO, they'll come, they'll make a case. Maybe the board will grant that. But hopefully the board members have been through a class like this and they recognize that financial leverage is one of the drivers of return on equity. So they're going to ask some questions. And they'll probably pay more attention to return on assets in that instance, because what they really want is a skilled man. They want a CEO, they want a CFO, they want a skilled management team that knows how to run a business, knows how to drive efficiencies, knows how to position that business. In module 1, we talked about Porter's 5 forces, we talked about SWOT analysis, we talked about pricing power, we talked about moats. Those are all components of strategically positioning your business for future returns. And if you want to tie your management team back to something a little bit more solid and not just a financial chicanery, you might focus on return on assets. And you'll probably find that a lot of your management teams are tied to return on assets, return on invested capital, and a handful of metrics that add more confusion than they really create. Return on assets, I think I covered everything on that slide. Here's the basic calculation for Pfizer. We looked at Pfizer's return on equity, and I think it was 36. Take those same components off of Pfizer's balance sheet, and you get to 16% return on assets. So what's going on there? We know immediately, without really even looking at the balance sheet. I mean, I skimmed through it there, but I didn't pause to note what Pfizer's liabilities were. I didn't pause to note what Pfizer's debt was. But I do know that Pfizer's return on assets was calculating at 16.6, and I do know that Pfizer's return on equity was calculating it at 36%. So what's that tell us? Well, the only missing component, the only difference between return on equity and return on assets is debt. So debt has to be the driver between the difference between 16% and 36%. So that's a big difference. We have a range for reference. S&P 500 firms typically between 4 and 6% during that time period. So again, Pfizer's crushing it. They're doing it with a lot of debt. Questions? Interrupt me, please. And the debt calculation is seen here on slide number 14. If we take the total assets divided by total stockholders' equity, we get a ratio of 2.18. So that's a pretty good financial leverage ratio. Okay, let's zoom in a little bit. Next step, we're going to look at return on assets, and we're going to set that equal to profit margin times asset turnover. So the more profitable each widget or each service that a company puts out, well, I guess the better. But that equation lays out as profitability times sales over average total assets. We call that average turnover. So the more widgets that we can put out, and the faster we can put those widgets out, the higher our return on assets is going. So that profit margin takes us back to module 1 again. Fortress by forces, SWOT analysis, mode. How do we defend our pricing power? That all flows through to profit margin. Asset turnover is an efficiency measure. So how quickly are we delivering our product? How much of an effect are things like just-in-time inventory systems, software systems, accounting systems, running our staff, everything, every expense line item on our income statement is an efficiency measure, and that all flows through to asset turnover. Here's the answer to our question why. Once we break this down, we have return on assets. We just looked at profit margin. Profit margin has 3 components. We have gross profit margin, operating expense margin, and then bottom line profit margin. We were just looking at bottom line profit margin, but if you're observing that your profit margin is going up, the next question is, why is my profit margin going up? And that can be on account of higher revenues, or that can be on account of lower expenses. So you look at your revenues and say, okay, well, revenues were the same as they were last year, so it's not relative. Our expenses must have been lower. Oh, okay. Well, we can see a couple of expense line items in our operating expense that are trending lower. Are those input costs, or those transportation costs, or those sales costs? What are those? And then the next question is why? How are we able to do that? Then the next question is it sustainable? Is it likely to repeat itself going into next year? When we look at productivity, same story. We're just gonna work down the balance sheet and ask ourselves, well, if these assets are generating more sales, which assets are responsible? Is it the inventory? Are we able to generate the same number of sales with less inventory than we were last year? Is it accounts payable? Are we able to generate the same number of sales or higher sales with lower accounts payable? Is it accounts receivable? Is it property, plant, and equipment? So we have ratios that will help us look at all of these. And our authors do a great job. They give us a cheat sheet here on slide number 21. I'm always pushing you to ask the question why. We see a change in a ratio. Why is that? Well, if it's gross profit margin, you can see the bullets on the left hand, that's competitive intensity has increased. Product line has lost appeal. Product cost has increased. Product mix has changed. Volume has declined. Where do you find this stuff? You find it on the balance sheet. My question was, if competitive intensity has increased, you'll see the numbers on the balance sheet. Where would you find the explanation? Like, how would you know competitive intensity is?
Or the managerial report.
10K managerial report, what you're gonna be looking for is management's commentary about what's going on inside the business. And they do this 4 times a year. They have a quarterly call, and consider yourselves deputized as financial analysts for 2 West Advisors. So that's my company. I own it with 2 other partners. And if you want to dial in to any company conference call, you can say, my name is Vern. I'm an analyst with 2 West Advisors. We're legit, so they can look us up on SEC registration. And that gets you onto the call. So now you can have a conversation with the management team of any of the companies that we're just looking at. And you can say, hey, you say, hey, I noticed your gross margin went up. Why is that? Are you seeing more competition? Now, these people are really, really good. They know what questions are probably going to be asked because they do this every quarter, and they're going to tell you in advance. Like, we own some DaVita. DaVita is a kidney dialysis. So, it's owning DaVita is a great company. They do good work, right? Because you have diabetes and you need to go get your blood cleaned, and you go into the DaVita lab and you put yourself on your dialysis machine, you get clean blood. Yeah. Well, sometimes being a stockholder or living in a capitalist society warps what you root for. These GLP-1 drugs, everybody's familiar with GLP-1 drugs, these weight loss drugs. Well, these weight loss drugs have been bad for DaVita because the fear is that not as many people in the future will have diabetes. So that'll make the demand for blood loss treatment decline, and DaVita stocks will get hammered. Well, we know the road on it. Then they reported earnings, and their stock dropped by 25% because the margins have been much strong. I guess in a nutshell, the fear was overblown, and there's always going to be sick people that need to get dialysis. So the margins are so strong, and they have visibility or what I thought that's like they told this story. My point is, when I ask where do you get this information, if you just dial in the conference call, management will tell you. If you just print the transcript, management will tell you. If you just read the analyst reports that are on the Bloomberg machine, you can get it straight from the analysts because they were on the call and they're writing reports for their investors. So there's all kinds of places to get this. You're going to be able to find it. ChatGPT will probably tell you. Okay, this is a great chart. This is produced for the S&P 500, but it could easily be produced for Goodyear Tire or Exxon or any of the companies on that chart we were looking at the start of the class. What you want to observe are operating expenses as a percent of sales over time. And this is, again, this is for the S&P 500, but if it were for Goodyear Tire or even DaVita, you can see that operating expenses have been declining for the last, well, this is a strange time period because it ends in 2022. But, any guesses as to what might be driving lower operating expenses for companies in the S&P 500 over that time horizon? What was going on between 2013 and 2022? All of a sudden, it got cheaper to run a business. So COVID would have been right here, and yes, that definitely had an effect.
Could it be AI?
AI really didn't have AI in, like, 2022 was like, that might have been like the very, very beginning of AI.
Maybe they invested in doing stuff online right at 2020 and then the operating costs went down, but they have to pay for facilities.
So that probably is a reason why you see cost decline throughout. It's just like the general pace of technology. So maybe not AI yet, but the beginnings of AI, and maybe not, specific to software, but just not the beginnings, but the continued use of software throughout is a cost deflator.
Then the debt servicing costs were going down during that
So
time?
that's the one I was wondering if it might pop out. One of the predominant themes on Wall Street for this period of time was a steady decline in interest rates. We saw interest rates decline. So the 10-year, we were talking about the 10-year earlier. The 10-year declined from about 6% in 2013 to, what did it, I think got as low as 0.25% in 2021 or 2022. So corporate America, they got free money and all their borrowing costs went down. And when your borrowing costs go down, your operating expenses go down too. So anyway, that might be part of it. Look at that data for the companies that you're looking at this semester. Notice any trends, ask the reason why, go do some digging. These are the ratios that we use when we're breaking down efficiency a little bit more granularly. These three ratios go into a calculation that we call the cash conversion cycle. The cash conversion cycle measures how much time it takes for a company to source the funds to produce a widget, buy the inventory, sell the inventory, and collect on the accounts receivable. That can be a lengthy process. We calculate that by computing days inventory outstanding, days sales outstanding, and days payable outstanding. You see there are three ratios here. We have average inventory over cost of goods sold, average accounts receivable over sales, average accounts payable over cost of goods sold. Then we're going to multiply that times 365 to convert it into days. Here's what that looks like for a few of the industries in the S&P 500. You can see the median cash conversion cycle varies pretty significantly. If you're ExxonMobil or if you're in the energy industry, you can probably source the funds and get the energy out of the ground and sell a barrel of oil inside of 10 days. Communication services, healthcare is on the high end over here. Let's look at, I think Pfizer's is on the next page. So Pfizer, we have their days inventory outstanding at 96 days. So it takes them 96 days to get a piece of, they call it a widget through their inventory system. Their days payable outstanding, it takes them 66 days to collect the cash. Their days sales outstanding, 41 days, and it takes for them to pay their suppliers. So the net of that is 71 days. So it takes Pfizer 71 days to turn inventory into cash and collect that cash. Now we, as a financial analyst team, can run that business in such a way that we can reduce that cash collection cycle by even 1 day. We're talking about billions of dollars. And if we can take $1 billion and reduce that by 1 day, well, that's a day that we can collect interest on that money. And 0.5% on $1 billion is more than enough to get anybody in this room paid for a year's worth of a salary. Okay, now let's look at Apple. Apple is unique, and I have never seen a business more powerful than Apple when it comes to their cash conversion side. Apple is such a beast in the world of whatever the world of finance. When it comes to cash conversion cycle, they contract with all of their original equipment manufacturers, and their contractual agreements require those original equipment manufacturers to produce the inventory without getting paid. So Apple collects on all the phone cases and chips and software and everything that goes into the phone, but they don't pay any of their suppliers. They just bring in inventory. Then they make the phone. Then they sell the phone. Then they collect the revenues from those sales on the spot. The Apple doesn't make accounts. Well, if you buy a phone from Apple, you pay Apple that day. They don't have to wait and collect the money. And then they wait an additional period of time, I don't know how long, before they cut a check back to the original equipment manufacturer. So if you're doing business with Apple, you have to wait 63 days or longer before you get paid. And that's unheard of in the world of business. And it only exists because everybody around the globe is jumping at the chance to do business with Apple because they're the largest and most premier phone manufacturer in the world. I'm still a Samsung guy. Anybody else here on an Android system? One? All right, these are my people. These are my people. Yeah. My daughters make so much fun of me, but I'm an old dog. I know where the buttons are. I know how to operate an Android, so I'm stuck. Okay, property, plant, and equipment turnover. This is another efficiency measure. We're just gonna take sales like we have throughout this module. We're just gonna take sales and we're gonna divide that into another line item on the balance sheet. So this tells us how many dollars worth of sales is each dollar of property, plant, and equipment that we have invested generate. So we're gonna take this ratio, we're gonna compare it to our peers, we're gonna pair it, and we're gonna look at it across history. We're gonna try to isolate, identify any fluctuations, and then we're gonna ask the reason why. What changed? What happened in 2002 that caused that ratio to spike? What happened last quarter that caused that ratio to, property, plant, and equipment? That doesn't change very much, so you're probably not gonna glean any huge insights from this particular ratio. But if you buy your business or have a lease, or if you're looking at Southwest Airlines and they've signed a new lease facility with one of their airline manufacturers, then this might be a ratio that changes pretty significantly, but it should also be pretty easy to explain. Okay, financial leverage. We talked about this first one, total liability, total equity. We actually talked about total assets divided by total equity, but they're those assets, liabilities, and equities, they're all part of that basic accounting equation, so you can swap one out and still glean the same insights. This is one of the basic equations. So we're looking for two types of equations when we're talking about how levered a company is or how much risk they have on their balance sheet. This first one identifies general risk, total liabilities to equity. It tells us to what degree a company has been financed by debt. And the second one is most relevant to whom? We have lots of different users. We talked a little bit about users in module 1. Financial analysts and portfolio managers and employees and times interest earned. So we have the earnings before the interest. So how much money did we make before we have to pay interest on everything that we've borrowed? Divided by the interest expense. What's this ratio telling you? I haven't even shown you what it is for Pfizer yet. What's your gut tell you that you'd like that ratio to be? And who are you? I'll tell you who cares about this ratio. The bank cares about this ratio. And the person or business who has lended the money. They want to get paid. So this is how they know whether or not they're going to get paid. So if you're the bank and I've borrowed money from you, you want this ratio to be higher or lower. If that ratio is 1, how do you feel about it? That doesn't make me feel so good, because if that ratio is 1, that means that the earnings before interest and tax, we'll just call that 100,000. Divided by interest expense, 100,000 equals 1. That means every single dollar of quote unquote profit or operating earnings before interest that was earned went to pay the interest. There's nothing left over. If that ratio is 1, there's nothing left over. Okay, so how do we feel if that ratio is 20? And you're the bank. Okay, I have to calculate this ratio for the bank that lends us money every quarter. Every quarter, they want to see that ratio. They call it a little something different. They call it a fixed charge coverage ratio. They give us credit for things that are non-cash expenses. So we'll talk about depreciation and some other non-cash expenses. They like to see it from a cash standpoint. But when it boils right down to it, we're talking about the same thing. How much money did you make relative to what you owe us? And if you made a lot more money than what you owe us, that makes the bank feel really good. The bank's gonna say, would you like to borrow some more money? No, thank you. We're good. We can't even borrow any more money. Okay, let's see here. We got 15 minutes, so I'm gonna have to pick and choose what we cover with the remainder of our time. I thought this note was interesting. Okay. We already established that one of the quickest and easiest ways to boost your return on equity was to do what? Get some debt. Let's borrow some money. Everybody likes to borrow some money. Let's run that credit card up. That's fun. Okay. This is an analyst adjustment. We're talking about Apple here. So consider the return on equity of Apple. From 2018 to 2022, Apple's total net income was $366 billion, and its stock buybacks totaled $409 billion. What's a stock buyback? How do you carry that? So yeah, so if you're Apple, you just I log into my Fidelity account and just buy some Apple. They would actually go through a different broker, but they're just buying the stuff. They buy their own stuff. Company buys their own stuff. Well, what is stock if not by a different term? Equity. Okay, so when Apple buys their stock back, they're buying their equity back. What happens to the denominator of the return on equity calculation? It gets smaller. What happens to the net calculation of return on equity when the denominator gets smaller? It goes up. So let's go back to right where we were before. If you think you're going to have a return on equity of 10% and you need 11 to get paid, what are you going to do? I'm going to buy back some stock. I'm going to borrow some money and I'm going to buy back some stock. And this little note is telling us what happened when Apple did that. Apple bought back $409 billion worth of their own stock. And that had the effect, last sentence, the effect was to increase their ROE from 49% to 176%. I guarantee you Tim Cook got paid in 2002 when Apple did that little transaction. The authors are giving us a little word of caution here. Stock buybacks have been so prevalent over the last few years. Sometimes it makes it hard to calculate some of these ratios because there's not even any equity left on the balance sheet. It makes some of the numbers nonsensical. So as an analyst, what do we do? Well, we have to default to return on assets, or we can make some adjustments you'll hear me talk about adjustments all semester long. These are analyst adjustments, these are pro forma numbers, these are numbers that we just kind of, well, we make them up, they're pretend numbers. They're meaningful to us because we have a use case. And what we can say is, we can say, well, let's pretend that Apple never did that stock buyback. So we're gonna take $406 billion worth of stock buyback, decrease or increase equity by 406 billion, decrease cash by 406 billion. And now we recast, the term that financial analysts use is recast. We've recast the financial statements into something that looks like, well, now we can use it. And those are all make-believe numbers, they're pretend numbers, but we can use them. We can use them to make decisions as financial analysts. And that's a huge part of this class. Everything that we look at in this class will ultimately be recast or adjusted for. Okay, so we made it all the way through the DuPont method. We broke down return on equity into components, including return on assets and financial leverage. And then we broke down return on assets into components that included profit margin and various efficiency ratios. And I had that little colorful chart there with all the different ratios. I want you to go back to that chart and make sure you're familiar with all those ratios for the companies that we're working on. This is another method, and I won't have time to go all the way through this next method. And that's okay, because it's not as prevalent in practice, but it is still useful. And the way that we utilize this is by taking the balance sheet and the income statement and differentiating operating assets and operating income from non-operating assets and non-operating income. When we're using the DuPont method, it's very clear that there's a huge component that's non-operating, and we call that financial leverage. So interest expense and interest falls into the non-operating category here, but there's a lot of other pieces to the income statement and balance sheet that will also fall into the non-operating category. So we're looking at some pretty big businesses this semester: Pfizer, Apple, not so much today, but several years ago, probably before they issued the stock buyback, Apple had close to $500 billion on their balance sheet. Well, $500 billion on their balance sheet almost every quarter. Their management team would get asked by analysts on their conference calls, what are you doing with $500 billion on your balance sheet? Why? Their management team gets paid, and they get paid by the shareholders, and we're putting ourselves in the position of shareholders. So you have the right to ask the question, why am I paying you to hold $500 billion? Why don't you just take that $500 billion and reissue it to me in the form of a dividend? I'll put it in the bank and make some interest on it. It's your money. Why are you paying the management team to hold all the cash? That's a very legitimate question. And I suspect it's part of the hounding that their management team got that caused them to put it to work in stock buybacks. That much cash on a balance sheet is a non-operating asset. So in this exercise, we're asking ourselves, well, what would the return on assets be if we excluded all the non-operating assets? And that gives us some visibility into just the infrastructure that has been put to work, generating cash for the business. So if you've ever read, I forget the name of the book now, but it's by, it's about the merger of RJR and Nabisco in the late 80s. This was a strategy of corporate raiders. They would look for businesses with unused assets on their balance sheet. They would buy the business, they would immediately sell the unused assets, and then arbitrage the difference between what they could sell the unused assets for on the open market and what they had just purchased the whole business for. And oftentimes you could get businesses for a song. Barbarians at the Gate is the name of that book. It's a terrific book. So that kind of covers this section of module 3. we're differentiating operating assets for non-operating assets and focusing on the operating assets. And that gives us more insights into just how talented the management team is when we calculate it that way. The two primary inputs are net operating profit after tax, operating there again being the key term, and average net operating assets, operating there again being the key term. Let me give you an example of operating assets and operating liabilities here on slide number 39. Our authors give us everything that you see typically on a balance sheet. Accounts receivable, inventories, prepaid expenses. You need all that stuff to operate. Operating liabilities. This gives students a lot of confusion because there's not necessarily any one common naming convention for operating and non-operating assets. And that's as frustrating as all get. When you're looking at some of these businesses and you see a line item on the balance sheet, you're trying to ask yourself, well, what is that? Is that operating? Is that not operating? The real question is it core to their underlying business? Sometimes that's not even clear. You have to go digging in the fine print sometimes to really discern whether or not it's core to their underlying business and should be an operating, or it's non-core to the business and should be in non-operating. But before you get stressed out about any of that, look at the number and ask yourselves if it's material. If you have $100 million balance sheet that you're analyzing and you got some line item that's $5,000 that you don't know is operating or non-operating, it doesn't matter. It doesn't matter if you're right or wrong. Just discard it. It's immaterial. Now, if it's material, you'll have to go do some digging. And the nice part about that is that if it's material, it will most certainly be disclosed. So you'll be able to find a description of what the heck's going on. All right, so I'll just give us an example, reference this when you're trying to discern operating from non-operating, but again, it's not clear cut. I take issue with this one right here, non-operating assets. I gave you the example of Apple sitting on $500 billion of cash. The very first bullet point there is cash is a non-operating asset. Certainly in Apple's case, that's non-operating, but I think you'd be hard pressed to find any business that doesn't require a little bit of cash just to keep the lights on. Yeah, petty cash is the heart of every business, but petty cash is probably insignificant or non-material. So if it's accumulated in any meaningful way, cash is probably non-operating. Derivative assets, discontinued assets, long-term investments, so on and so forth. Okay, for the numerator of NOPAT, net operating profit after tax. Again, think about the calculation that we're working on here. We're trying to isolate operating assets. We're trying to isolate operating income. And we're doing that because we want to take an assessment of how this business is performing as if, pretend, that it doesn't have any debt on it. Interest, liabilities, those are non-operating assets, and we're trying to differentiate the two. So we're going to pretend, we're going to make an adjustment, and we're going to subtract off the tax on operating profit. So in your finance classes, you've probably heard this referred to as the interest tax shield. We're calling it the non-operating liabilities tax shield. I hate that. I don't like the way the authors have presented this. But I can follow it. They're technically accurate, but they really write it as their accountants. Again, it's not an accounting class, this is the finance class. So that term that we have on the end, the tax on operating profit, that's part of the interest tax shield or non-operating asset tax shield. So we have the operating expenses that our author's list here. I won't read them off to you, but our net operating profit after tax equals net operating profit before tax minus that tax on operating profit. Here's the calculation for Pfizer. You can see net operating profit before tax equals revenues, less cost of sales, less operating expenses, which are highlighted in the blue there for a calc of 34 billion. So that's laid out there pretty simply by the authors. I can kind of skim through it. There's the tax shield, and I think that is pretty close to where I wanted to get to in this selection. Yep, that's it. Okay. Check out the slides. There's a few I didn't touch on, but I got all the notes and I wanted to bring them back. We're almost at time. Any questions before we call on Matt? Okay. Thanks for your time, y'all. I'll see you next time. Oh, you do. You 100% do need it. And if you have the hard copy, then when I'm lecturing on the balance sheet, have a question like, what's an operating asset? What's yeah, absolutely. I think it'll help you out. Sorry. Next.
Your class last semester.
Oh, you did?
What's your name? Yes, I did all of the work. It's still in. I bought it.
Okay, so I went into the slash.
Yeah.
Somebody in the class, the homework is already covered.
Yeah, so I did all the homework.
Oh, good for you.
You think one of the questions I'm doing, so is this what you're wanting for the driving assignment? I downloaded it for today. Yeah, I'm finding what I think of the analysis.
That looks terrific. So it's an A pass fail assignment. So you're gonna get 100% of the points or you're not gonna get any. And those points are primarily gonna be awarded based on whether or not we've identified. The rest of it is encouraging.
Okay. Homework.
You have, the homework's due every Tuesday before class, but if you can't get it in Tuesday before class, I don't count. So.
No, I did that.
And then for facts that is what,
This is a.
Dr. Clark.
Yeah, check your email to get a login or whatnot, and if you don't get it, just let me know.
They set up, I was just taking too many classes last semester, I forgot to log the class, so I held it. So now.
Yeah, I had mentioned last week that